stuff. Good to be here with my friend Ben Kogut, local to Austin also. So we have a great panel today. Matthew Kessler and Jeff, I see you here. Good stuff. I like to say I like to be the least smartest in the room, and I feel I am today. Great content, and this is going to be a wild panel. So I said let's just go down the line, have everybody introduce themselves, and then we'll kick it off with some questions. And the folks here can be lively in the audience and online. I'm sure Marty will have the questions coming. So Matthew, good to see you.
Good to see you. Thank you very much. Ben, welcome. I'm glad you're on the panel. So joining the team. And then obviously my good friend Jeffrey up in San Francisco. And Marty, thank you very much for pulling this together. And obviously a big shout out to IvyFON. We're doing such an amazing job of, putting this together, but more importantly, allowing family offices access to what we believe is one of the best asset classes in any portfolio, which is commercial real estate. For myself, I'm a 40-year veteran of commercial real estate funds, packaging, as well as pulling together loans throughout the entire capital stack, whether that's equity or debt or mezz. And for me, currently, I work for a firm called Menlo Pace. I'm part of a family office. The family office that I work for is a $5 to $10 billion balance sheet lender in construction, in equity. And obviously CPACE, I hit up their Menlo Pace portfolio. For me, I have a FINRA Series 7 license, insurance license, California real estate license, and few others. Graduated from American University in Washington, D.C., and hold a couple professional memberships. Actively involved in volunteer and community service work, whether it's Amnesty International, Children's Hospital, LA Regional Food, Make-A-Wish, Ronald McDonald. So I find that giving back is so important. And then a quick idea on us at Menlo Pace. We're a leading property assessed clean energy. That's what Pace is. Commercial real estate provider of loans for energy improvements. Menlo Pace financing can be used for new construction, retrofits, mid-construction, cost overruns. And as a balance sheet lender, we are extremely knowledgeable about the 37 CPACE states that CPACE is allowed. And then I think if you're thinking about gap financing, we're a perfect tool for gap financing. We are much lower in terms of cost of product if you're going to be borrowing money. And then I think what's nice is that we're also give you construction money, and equity money is available. So we're a full, lending firm as well as a CPACE firm. I'm located in Los Angeles, California. Jeff?
Thanks, Matthew. A little bit about us. HLA Ventures is a San Francisco-based real estate private equity firm that's invested more than $350 million in investor capital to acquire both multifamily and retail assets. Our multifamily platform builds long-term wealth through ownership of conservatively leveraged portfolio of quality apartments. We call this the Generations Program. It delivers tax-sheltered cash flow and equity appreciation over a long hold period of more than 20 years. Our average investment offers a 12 to 14% yield over its initial hold period. Our retail platform is a value add and developed core strategy designed to acquire a geographically diverse portfolio of neighborhood shopping centers aimed at 8% annualized quarterly distributions and internal rate of returns of about 18 to 20% over a 3 to 5 year hold period. A little bit about me. I've been in the industry for about 35 years, live in San Francisco Bay Area, hold a bachelor's degree from Northwestern University and a law degree from University of Pacific McGeorge School of Law.
Got it. Yeah. Wow. Impressive, you guys. Ben Kogut here in Austin, Texas. I am the founder of Rooster Equity, a boutique commercial real estate investment firm. We specialize in buying shopping centers, medical buildings, industrial buildings around the U.S. We've bought a few $100 million worth of real estate, so not quite as big as my esteemed panelists here, but we're growing and we're hungry, and working with quite a few little family offices and basically representing them on the real estate side. And happy to be here. Thanks.
Matthew reminds me I'm licensed Series 7 under BB Securities out of Dallas, Texas. Our focus is Class A multifamily development. And I've been playing in the niches for a while now, from the solo 401k, as the Quest folks talk about, all the way down to the Delaware Statutory Trust, the DST, and the 1031 world. So with that, we're at a family office show. Matthew, let's start with you. During this time of uncertainty, how do family offices deploy capital and to which asset classes?
Great question. I think family offices, when we think about their portfolio, it's 100% portfolio. They're in all asset classes. But then when they break down real estate is anywhere from 12 to 15%, maybe more of their portfolio. And then of that real estate portfolio, some are going into funds, whether it's, aggressive funds or they're going into stabilized funds like we see with Jeffrey, or they're going into REITs, or they're buying public equities. That could be a portion of their funds. Then also, when you think about their real estate mix, it could be direct investing in real estate. Maybe it's multifamily on a 3 to 6 unit basis. Maybe they're direct with other co-investors. Maybe they're part of a fund of family offices where one single family office runs the assets for others. And then they can go direct themselves and start buying commercial real estate. So when you bust out that 20% of their real estate portfolio, it's really well diversified. And if I think about where they should be investing, for us at Menlo Pace, the moment we believe the two asset classes that are doing extremely well is multifamily. We're talking units of anywhere from 25 to 100 units. We think that Section 8 housing is amazing, with the government being your partner. That is a 20-year opportunity to partner with the government, put in obviously renters in the portfolio and see that the asset goes up. So that's multifamily. We also think, rehab multifamily is extremely strong right now. And new construction, doesn't matter where it is, there is not enough multifamily out there. And then the second asset class would have to be in the medical area, whether it's memory care or you're thinking, hospice care. The medical field, whether you're thinking about blood plasma care, if you're going to buy a warehouse and put blood plasma, facilities inside, there is so much work to be done, not only in medical, but in blood plasma, but in multifamily. And then we also really think that the warehouses, that last mile, whether it's cold storage or it's an Amazon provider, all of those areas are extremely profitable. And we think that the multifamily offices or single family offices for generation 2 and 3 going out the next 10 to 15, 20 years is an excellent asset class to be in.
Wonderful. That's great. Jeff, the types of real estate that your firm is purchasing, what trends are you seeing?
I would say that probably the biggest trend is the work from home shift. I think that's really changed the entire sort of investment profile for us in retail and multifamily. I think the renters are prioritizing suburban living, and they can, they're looking for units where they can, live in sort of spacious living environments and staying away from crime. So they're looking for bigger apartments. The demand drivers include more swimming pools and fitness areas, dog parks. On the retail side, we're seeing kind of a movement away from the foot traffic in urban areas and more of more retail shopping in suburban areas where people have more time to shop during their lunch hours and so forth. So that's really the biggest shift we've seen since COVID in 2020.
Let me, before you, move over to Ben, let me pick up on that. This work from home is destroying the office market, as we all know. The office market has just been decimated. Keys are being handed back, as we're seeing, in every, source outlet, from, San Francisco to, Miami to Los Angeles, California, to New York City to Boston. Keys are just being left. And we have to talk about, and I think we can do this at a panel, during this course of the hour, is how do you retrofit? How do you multi-purpose? How do you change what's happening to these empty office buildings, and how do you fill them up? So I think that's something we absolutely have to talk about.
Absolutely. Step back a bit. I love self-storage. It was a niche about 10 years ago, and I feel one of the new ones is car washes. I know a trend, Ben, you pick up on. Can you share a little bit more on that?
Yeah, just we've been investing in car wash business. Basically, our little niche that we found that has become more programmatic is we invest alongside the tenant. So we're working with tenants who are growing their business model and they may not want to put all their equity locked up into their real estate. And so we come in as a partner with them on the real estate side. Happens to be car washes, happens to be some other types of triple net, single tenant assets that we're doing, and it allows the tenant to expand. And we've been structuring it so that all of our incentives are aligned, so that we hold hands with the tenant, grow the real estate portfolio, give our investors a great return, and not to mention all the tax benefits that come with it as well. And so, yeah, that's another little initiative.
That's like a sale leaseback?
Yeah, it's a sale leaseback. Yeah, the tenant will sign a 15-year term lease. And so in the capital stack, they'll sign on the debt, which is about 65% LTV. And then the rest of the equity stack, they'll put in half of it. We'll put in half of it. They'll give us a nice prep on our money, and then we'll hold hands for a few years to cash flow it. And then once we sell it out on the triple net market, we'll unwind the whole thing and split the profits so that the investors are treated favorably.
Dan, you asked in a sort of a nice aside, which was the storage facility area. We believe, again, at Menlo Pace, and our minimum investment, if we're going to do a C-PACE loan with you, or debt or equity, is 20 million. So we love storage. We think storage is probably one of the best areas, not only for institutions, but high net worth family offices, because if you have the right operator who has the ability to manage a property, they can do it very well in terms of the economics. But more importantly, the mom and pops that own these self-storage are starting to sell because their next generation don't want them. So again, for those in the audience and those online, for storage, it's a marvelous asset class to include in your portfolio. Jeff, thoughts on warehouses or car washes?
Well, I'll go back to your self-storage. We've owned a little bit over the years and find it, like you said, a great asset class. I mean, the risk is very low because you don't have the tenant improvements like you do in office or retail. We sort of laugh about it and say that the only tenant improvement you have is a hose, where you're going to hose out the units and get it ready for the next guy. So pretty low risk, low cost.
You like warehouse? What are you thinking about warehouse?
We don't invest much in the way of warehouses. We've owned a little bit of that asset class over the years, but pretty much in the past 8 or 10 years, we've been investing mostly in multifamily and retail.
Nice.
Matthew, one of our favorite comments from our pre-conference call, you said the malls got mauled, which I think is a great spelling bee for my 7-year-old at home. But it's been a tough putt, of course. What's next?
Well, great question. I think the malls did get mauled. Let's talk about Target. Let's talk about CVS. Let's talk about Macy's, Rite Aid. I mean, that group alone is closing 300 stores across the country. The malls are just getting decimated. Bed Bath & Beyond shutting down 896 stores. Foot Locker, 545 stores. CVS shutting down over 380 stores. So the major retailers who are in the malls are closing. One, we all know about crime in the areas that we know about crime, but it's just not there anymore. I can now go online in 24 hours or same day delivery, have that product at my home. So when you think about what's taking place in the malls, how do you redevelop it? How do you repurpose it? What do you do with it? I mean, are you thinking about putting in veterans and maybe turning the whole thing into individual apartments? Are we thinking about turning them all into gymnasiums? Are we giving it to schools? Are we then creating an area where we can give it back to the public? I think the hardest part is repurposing these malls, because it's thousands and thousands of square feet. It is a massive eyesore to the city, and we agree. We really believe that this mauling that has taken place of all of these shopping centers, they have to be repurposed, and I think it's going to take very deep money and huge subsidies and tax breaks from the city and governments that they're in is the only way you're going to put these back on track. Here in Los Angeles, we had a huge mall just right down the street from where I am in Century City in Santa Monica close. Google moved So what Google did was they took over the entire property and are now building it into offices, and the whole area in terms of property prices are propping back up. So I think if you have that kind of a tenant who can move into an old shopping center, repurpose it to office, and move in and have obviously the balance sheet as Google does to make the property work, then the malls can work. Otherwise, I think it's going to continue to have a very big eyesore in the communities and tax drag because no money is coming in.
That's right. No, and to your point, Matthew, we've seen a couple malls up here attempt to be repositioned. One is up in Marin County at the Northgate Mall, and unfortunately, they're hitting a lot of environmental roadblocks. There's major traffic impacts. The developers want to turn it into multifamily, and the roads just can't handle the extra pedestrian traffic. So that's one issue that's facing malls. We're also seeing malls being turned into industrial, believe it or not. Hilltop Mall was purchased by Prologis, and they're turning it into last mile distribution because of its proximity to San Francisco and similar communities.
The only thing I'll add to what you guys are saying is converting extra space into pickleball courts. I'm all for that. So that turns out to be a pretty good business for the pickleball industry. So,
well, it's actually not that funny. We had in Cleveland, Ohio, we had a shopping center where, to Matthew's point, Bed Bath & Beyond went out, and we are turning it into an indoor pickleball facility. It's very, very popular.
And safe. Yeah, I mean, we can't really kid ourselves about this demullification because the reality is all this extra traffic in our cities is disastrous. And I'll give you a great example. In New York City, they built out all these bicycle lanes so, people could be free and easy and ride their bicycle. And there's no bicyclists on any of the New York City bicycle lanes. It's all these guys on motorized sorts of delivery vehicles that are, motorized bicycles or motorized, whatever you call the other things, that, people just go at 40 miles per hour through this single lane to deliver packages, right? I mean, I think it's catastrophic. I don't know. I mean,
it's terrible. Let's say I'm TIAA and I own, as billions and billions and billions of mortgages. I'm not in the real estate business. I'm in the lending business. So if TIAA, has a portfolio, which they do, of office buildings and shopping centers, they are dying to move these out. We have 3 buildings, and everybody knows Beverly Hills, and everybody knows Rodeo Drive, and we all know the hotel Beverly Wilshire where the movie Pretty Woman was built. Filmed. There is 3 or 4 buildings just around that really high-end area of Rodeo Drive and Wilshire. You cannot put a tenant in. The buildings have remained see-through or empty for the last 3 or 4 years. There's some beautiful properties across the street from the Beverly Wilshire on Rodeo Drive, and CREF owns them. Nobody can move into them because they just can't get the rents to work and the taxes to work. So we, right here in one of the most profitable streets in LA, Rodeo Drive, we can't fill them up.
So that's one of the premier streets in the country.
Lined with gold, absolutely lined with gold. Name a jewelry store, name a clothing store, name, a big name. They all have that sort of loss leader store there. But to have multiple properties on a street like that, and the corner across the street from the Beverly Wilshire Hotel, which is right down the street from the Peninsula, right down the street from Beverly Wilshire, Hilton Hotel, they can't find tenants and nobody will buy the properties. So right here in Beverly Hills, we're having big problems again with the malls getting mauled, see-through properties, and more importantly, these office buildings that were once retail, let's say Saks was in them or others, they cannot fill them up, and the city's upset because they're missing that revenue. Big problem.
And Matthew, I would say that in San Francisco, and everybody now likes to hate on San Francisco, right? But a very similar phenomenon is happening. These retailers that you've read about, Macy's, the flagship 700,000-foot store downtown closing, Nordstrom's closing, and the list goes on and on and on, which is really killing the foot traffic to make even that more difficult to put in restaurants and the like. The other thing somebody mentioned was, is turning these roadways into bike messenger alleys. They've done that in San Francisco. The politicians think it'd be a good idea, and all it's doing is creating gridlock traffic and making it that much harder for people to get downtown and shop.
Right.
When I hear
Right.
Beverly Hills, San Francisco, and Austin, I think, fashion and I think technology. So with that, a little tongue in cheek, but I guess two questions, and feel free to pick which one. What kind of, think of hot or not, what do family offices want to invest? And then on the other side, we are here in South by for South by Interactive. What sort of positive tech advancements will benefit sponsors and investors?
Yeah, I'll jump in just from a tech perspective. There's quite a bit of AI being utilized. We use a service called Placer.ai, which uses cell phone data to track how often people go to certain locations. And so that has, and then with that, they'll tell you exactly how that, let's just say, we look at a lot of medical, so like how they care now, how that location compares to the other locations within it based on cell phone technology. And so that's just one of the tools. We're seeing a lot of other AI tools coming down the pipeline and looking forward to taking advantage of that.
Well, I'll give you the AI tools right now. The AI tools are absolutely out there. Think about any building that you own that has HVAC, indoor air quality. You're talking about your elevator, your escalators, your solar, your windows, your plumbing, your roofing. All of that has now have AI technology all over it. The windows have AI technology to cool in the summer, warm in the winter. The envelope of the building is pure AI. Yes, the cost will improve, but again, for somebody like ourselves at Menlo Pace, we give 100% financing for those type of tools. But AI in those type of areas that I mentioned, from HVAC all the way down to roofing, has taken hold over the last 10 years. And that's why there is a tremendous push in every building using AI to get to a net zero carbon production out of office buildings, which, as you know, is a very big villain in terms of producing carbon. So AI is extremely important. And then again, with AI, you're watching those coming and going, and your security goes up. And how do you do what Jeffrey just mentioned earlier, which is you have to put people butts in the seats in these office buildings? And how do you do it? AI gives them all of the comfort they need for coming and going. And if you have to knock out a floor in an office building and turn it into a gymnasium to get your people to come back to work 3 days a week, then you're going to have to do it. But AI is the key, and obviously conservation and sustainability with net carbon neutral is so important, and AI gives you all of that. So thank you. Very great question, Dan.
But 3 days a week isn't enough.
Well, look, if I'm Jamie Dimon, or I'm running Bank of America, I'm furious that people are doing that. And the other thing we're seeing is that it's gone now. If I was living in New York and COVID smacked us in the face, right? So that's a pandemic. Now I've decided, hey, I don't want to live in New York City anymore. I'm working out of my little apartment. I'm moving to Colorado. That individual was making New York City wages living in Colorado. That stopped last summer. Every single major bank and financial institution, Goldman Sachs, said, if you were originally in New York or Philadelphia or Chicago and you've moved to the suburbs or back with your parents in LA, those wages you were earning will no longer hold. You will now get local wages. So people realize quickly it's going to affect their bottom line by not coming back to work. The other thing, and I know, Marty, you and I have talked about this before when you were last in LA, is culture. How do I instill in a worker who's joined my firm the culture of my firm if he and I are not together on 5 days a week and chatting about the firm, the company, the business, and I only see him remotely? Doesn't work. So I think getting people and giving them the benefits they need to come back to work, whether it's paying for their parking, paying for their lunch, paying for meals, whatever you can do to keep that individual in the office, those things are enhancing, and AI is part of that.
So I just have a comment, which is that Friday I had dinner with a major real estate investor, and they are saying that we are putting more and more entertainment into our buildings to try to coax people to come back to the office at least 3 times a week, because the problem isn't your middle management or your workers not want to come in the office. It's senior managers don't want to come to the office. If you're a senior manager and you're a producer, right? You can produce anywhere. Your purview might be the Southeast United States or whatever, but you don't want to go into New York when you're in the city. When you're in the area, you're probably like, okay, I can work from home, right? So a lot of these guys are saying, why even bother going in? So now they're kind of grasping at like, what's going to make it better for this guy to come, not only to come in, but to bring his wife and kids in, right? So that's how big the issue is.
It's tremendous. Jeff, thoughts about that? I know you and I have talked about that before.
Yeah, no, I would say just on a much smaller basis. I mean, our office, we have food and all kinds of snacks, and when people come to the office, but we're a real estate office, right? And so, it really makes sense for people to come into the office, and we require our folks to come in 4 days a week.
Wow.
Thursday being the one day off. But it's a tricky one because, in the Bay Area anyway, and I'm sure the same thing in Southern California, is people are saying, why do I want to drive an hour, hour and a half to work if I can get the same thing done at home? And, in some industries you can, and others you can't. In tech, for the most part, you can get it done. And that's the mainstay of a lot of jobs up in the Bay Area. Maybe not so much so as down in Los Angeles, but it's a really tough one to fight, and we'll see how it shifts. But there's a lot of office buildings downtown that are sitting vacant with people trying to figure out what to do with them, and converting them to residential does not work. I mean, we've talked to people that have run analysis on converting, a high-rise office building to residential, and the costs are absolutely insurmountable. You almost have to have the building for free, and even in some cases, it's cheaper to tear it down. So it's a big question mark.
You have the Transamerica building right behind you, right? And at least in your screen.
Yes.
What are you hearing about the building? How's the occupancy rate? What's going on in there?
Yeah.
I mean, that isn't a marquee building.
Well, it's a good question. It was purchased a few years back from a New York investor, and with Deutsche Bank, and they are, to your point, they are offering all types of on-site premises with concierges and massages and restaurants to coax people to come back to that building. But rents there, go upwards of $200 a foot. They're really marketing to, the small private equity shops or the venture capitalists that want views and a full array of amenities. But yes, it's they're putting, I think, $1 billion into renovating that building and the entire block.
Wow.
I laugh because it was just 10, 15 years ago working for GE Capital, where we had, I think, a vending machine in the basement. We were told to hit the button and like it. That was about the bit of amenities there. So times have changed, to say the least. We talked about the brick and mortar, some of the trends. Just want to talk briefly on the investing side. So Jeff, Ben, and then we'll go this way. Are your investors investing in funds or making direct investments, and what factors are driving their decision making?
All of our investors are investing directly in deals, and they really like to know kind of what they're getting themselves into on a deal by deal basis. That's the mainstay of our business. But I would say that probably the trend in the past few years for us have been several-fold. One is they want to invest in properties that have cash flow from inception and that offer more certainty of ongoing distributions. They want very clearly defined repositioning strategies, not I'm going to buy a shopping center and we'll find a tenant, but we're going to buy a shopping center and we're going to show you, 10 letters of intent. And this is even before we buy the center. I would say that increasing scrutiny of sponsors and track record are very, very important. If you've got something that goes wrong, there's a capital call, you want to make sure that your sponsor has, deep pockets. Then, they're also scrutinizing, acquisition of properties, looking at, how are properties being acquired? Is it fixed rate debt? Is it floating rate debt? What's the loan to value? Because there's a lot of problems that are occurring and will occur because of debt, basically floating rate or over leveraged. And lastly, our investors are looking at the tax benefits, particularly from accelerated depreciation on the multifamily side. That was a law that was enacted about 5 or 6 years ago and allows depreciation to be taken, all being taken up in the first year, which is pretty nifty. You can offset passive gains, and if you're in the industry, you can actually offset income. So it's an interesting advent.
Jeff, let me ask you a question about your funds. I mean, fascinating. If, the new administration, let's just call it the current administration, was to enact new real estate laws or, whatever happens within the administration, what would you like to see? If you could have a a wish list to help your funds. What would you like to see from the federal government to help you in terms of your funds? And what do big, owners of real estate really want in terms of benefits coming, out of the government? What would they like to see? What are you hearing?
I would probably, the one that kind of comes to me, which they're trying to get rid of, is the 1031 law. The ability for an investor to trade from property to property. And right now it's, the laws are fairly onerous. You've got 90 days to identify a property and 180 days to actually close on something. And in many cases, 90 days just isn't enough. And some folks are buying properties they probably shouldn't buy because they're making hasty decisions. So I would say the 1031 laws are something that should be looked at. Obviously the depreciation laws and perhaps extending the allowance to take accelerated depreciation would be helpful. Rent control is obviously one that, that's more on a state by state basis, but it's really hurting investors in California now that a statewide law has been enacted in addition to local rules. So those will come to mind.
Let me pick up on that to be just comment quickly. Here in Southern California, the super top grade multifamily buildings, they're not trading hands anymore because of the caps on rents. I mean, if I buy a new building, I mean, it's everybody stays where they are, and we're seeing maybe 1 or 2% bumps. And I found that since COVID started and through the end of summer last year, there was still somewhere between 25 and 35% of the renters were not paying rent. What if you are the owner of that building? How are you going to pay your mortgage? How are you going to pay your costs if 25% of your building is not paying because the law says they don't have to?
And you can't evict them. I mean, we had problems during COVID, which people just didn't pay the rent until they had to pay it, and then they left and went on somewhere else. So it was a real hit to a lot of our properties located in the Bay Area, especially.
Yeah, that's got to change.
Hey, Jeff, just back to your point about 1031, are you suggesting that they eliminate the 1031, or are you saying that they should extend the 90 days, or was there some other twist on that?
Oh, no, not eliminate it, but it provide some more leniency around it, basically extending time deadlines for, investors to invest. The other thing too is I think it would encourage people to sell and buy properties if they knew they had more time to do so.
Got it. Yeah, got it. Agreed.
No, we have a lot of family offices online here in the States and a few in Europe I saw earlier this morning. Matthew, to you, do you feel family offices are a source of capital for ground up construction and bridge loans?
100%. Great question. Ground up construction, bridge loans, gap financing, energy, opportunities, the ability to, refinance going back even 3 years. I think the family offices, because they are really mini institutions. I never look at a family office as a, just group of investors. I see them as a mini institution with $750 million to $1 billion under management. They're strategically managed. They're staffed top to bottom. And if it's not, an individual who's managing it, there's a team, there's a CEO, there's a CFO, there's an accountant, and their job is to put that money to work for Gen 2, 3, and 4. And if they're part of a multifamily office, then obviously the senior head of that multifamily office is making that decision. So family offices, have stepped up. That's also another word for private credit, because what is that private organization doing? They're taking the place of the S&Ls. They're taking the place of the commercial banks. They're taking the place of, the B of A's of the world and the Wells Fargos of the world and, the Credit Suisses of the world who used to be lenders. There is no longer risk on the table. Risk is off the table. And if somebody has the ability and the capital and the ability to make decisions quickly, family offices have all of that, because if risk is off the table, the next place that a developer is going to look is to the family office, or they're going to go to the PE funds, or they're going to go directly to the hedge funds, or the next place is they're going to the big, organizations like CREF, or they're going to the state funds, or even the financial portfolios of, say, a college or an endowment. They are looking everywhere for money, but family offices is usually the best, smartest place to find that kind of construction money, lending money, rehab money that you need. Family offices are flush and they're looking for a home, and we think commercial real estate's the place for them to be.
There's about 10 minutes. Do I have a question, please?
So, we have Peter Lewis on all the time. He talks about the future of real estate, and he was prescient in 2019 when he said, robotics ready warehouses, right? And he bought a whole bunch of warehouses, converted them over, and then COVID hit, and Amazon bought 3 of his warehouses from him, right? So what's your perspective on the future of real estate and a place to be? It's just like football. You don't want to throw to where the receiver is. You want to throw to where the receiver's going to be. So what's your perspective in terms of what's going to be a good place to be in 2 to 3 years?
Jeff, why don't you go first?
Sure. I would say the place to be is in suburban retail, necessity retail that's a center of it's anchored or anchorable by a supermarket, because supermarkets are never going to go out of style, so to speak. And I would say the same thing for multifamily. We've had tremendous success given the fact that people just don't, they don't have to be in the cities. And it cuts against the work, going back to work, but people want more space. They want larger rooms, they want amenities. And so I would say that the trend and the place to throw to would be suburban multifamily as well.
Love your answer. I'm in agreement with you. I think the suburban multifamily is brilliant. I think obviously multifamily that is near transportation hubs, whether it's rail, whether it's, subway, whether it's bus routes. I think people want, that ability to, move quickly inside of a city or even in the suburbs. And then if your MSA is really that large, I like the trend we've been talking about a lot, which is storage. I still believe in any capacity, whether it's, me emptying out my home and I'm putting it in storage, or it is, me moving across the country for a new job, or, it's the individual who is, a transient and he's moving from place to place from, different homes. They need storage. And then if you go to the next step with storage, if you're going to take, say, a mall, say a Target, right? You clean it out, you turn it into storage, you put a second floor on it, it's already in a top MSA area. So you take, a delinquent or a bankrupt mall and you turn that, if it's a 1-story or 2-story, into storage, and maybe you make it a little bit of retail. But again, there's so many opportunities. And if you're looking to where the receiver should be going to, I think these large, facilities that we can turn into, great opportunities. And again, blood plasma centers. I'm hearing this from my clients over and over. They want to borrow money from us for, a warehouse, which they're turning into blood plasma centers. And Marty, to your point, it's purely IT run, maybe 2 or 3 people on the facility, but blood plasma also for, storage is a great place to be in the future.
If I
can I just make one comment? One of the questions is that how many people does Target employ, and how many people does a storage facility employ?
Well, that's easy. 3 people at a storage facility running the entire operation. And if I'm at Target, I got 200 employees coming and going, 20 hours a day. So it's easy to run a blood plasma because or a regular storage facility, you need 3 to 4 people, and they're mostly tech people on staff.
But it's not great for income tax rolls. It's not great for income tax rolls. If you're a state or city collecting income taxes, you've lost 197 income taxpayers.
Less employees.
Or payroll tax?
Payroll tax, yes.
And the only other trend I would add to this is just senior housing or senior related type of housing. But we're buying suburban retail. That's where we put most.
Can I throw something out at you guys? What about mini sports franchising? So not major league, but minor league sports franchising, like soccer. And I think we've talked about this before, where the soccer leagues come into non-gateway cities. The cities build 10,000 person stadiums, and 50% of these franchises are built in opportunity zones. We will give the developers of the soccer team, or the investors will give them 10 square blocks of land to develop. I don't know, to me, that seems like a great opportunity. I mean, it didn't work so well where's the Dallas, is that Frisco where the Dallas Cowboys are? It didn't work so well for the regional developers out in Frisco, but for a lot of other people, they can make it work. Any thoughts on that?
Well, I know in San Francisco, London Breed, our mayor, is pushing that that strategy, but I think somebody's going to have to throw a lot of money at it, and I'm not sure who the lenders are on a strategy like that. But that's her idea to fill up these empty office buildings.
Yeah, it's extremely hard, Marty, because the family office has to step up. They have building naming rights. You have all of the, think of it as you're just taking, a basketball arena or a football arena and you're scaling it down to 10,000. Great. So maybe I'll stage a couple fights in there too. But you have to have somebody step up with deep pockets that's got, 10 years, in terms of maturity of that property to making money, either change hands or just cash flowing. And then you got a 3-year build cycle, right? So you got 3 years to stabilization. It's going to take a while to put something like that together. And then I got to get a league, right? I've got to find a league. I got to hire a team. I got to put a coach in. I got to get the players organized. It's a little harder to do franchise because if I'm an investor in a franchise, I am so far down the cash flow, line. It's too far for me. I'm not going to make any money. But if I'm the owner of it and I've got, co-investors, which is a better way to go than a franchise, I think the family offices have a way to make money.
Since we're talking sports, also hospitality, Matthew, what's your take on demand for travel? How does this play into real estate?
Oh, I think it's great. I think the demand for hospitality is there. Travel is back. TSA, as we all know, we can track them on a daily basis. Their head count has gone up 15-20% from where we were pre-COVID. So the, TSA lines are enormous. The travel is enormous. People coming to Vegas, which is nothing more than 5 hours or a 45-minute flight from me. They are doing extraordinary business. You've got 3 or 4 big sports teams, not only the Oakland Raiders, but baseball and basketball and girls, or women basketball as well. There is so much opportunity in the right city. The hotels on those major events are 100%. They're using predictable, financing in terms of, okay, the room was $25, now it's 100 because it's, the Final Four or it's the Super Bowl, etc. So the hospitality industry is doing really well in the right markets. And if you're with a good hoteler who understands what to do and they own the property, the construction companies like us, we are financing hospitality. So let me repeat that. We're absolutely financing hospitality. We, as our own family office portfolio, are buying hospitality in the right areas. We think there's been carnage. We think it's a great time to come back in. AI is reducing cost. If you were Lowe's last night, they must have said your name 15 times during the Academy Awards, because Lowe's is downtown, right next door to the Kodak Theater where the Academy Awards was held. Right place, right time, right MSA. Obviously hospitality doing well. The older, sad, quiet, tired buildings are not doing well. But again, right proximity, and you've got to have the right brand. The brand name is so important. But again, we like hospitality, we believe in it, and we think it just only has good upside going forward.
Jeff, looking out another 5-10 years, what's San Francisco? Are we all going to want to come there? And what's going to be do the dollars want to come down the real estate side? And what do you feel may change?
I'll tell you what's changing is the playing field in terms of politics and sort of I hate to get political, but the progressives really got us into this problem in San Francisco in terms of kind of putting kind of a short leash on police, and that's just snowballed into people not wanting to come to the city, not wanting to shop, not wanting to be in offices and the like. So I know for sure, I know a lot of people are behind getting rid of the progressives in San Francisco and putting in moderates. And I think that will help San Francisco a lot. But look, I mean, San Francisco has gone up and down. There's swings either way. It will be back for sure. It's a beautiful city. It's got tech and all kinds of things going for it. So I think it's going to, it took us time to get in this mess, and it's probably going to take us another at least 5 years to start getting out of it.
Hey, you've got Sand Hill, right? You've got every private equity firm, you've got every hedge fund, you've got every, VC fund right down the street from you. They're smart, they're agile, they know where to invest. So I really believe that the Sand Hill crowd, which is where all the best private funds are, they're the ones that care about their city, they care about the infrastructure, they care about transportation and taxes. And I think that's a great indicator of where the money is going, is to see where all the Sand Hill money is going.
Yeah, I totally agree with that.
and you and your family seen the growth in Austin and Central Texas, 10x, maybe 100x in so many years. 5-10 years out, is Austin still the darling? Do you still feel investment dollars are coming to Central Texas, or?
Yeah, I mean, my family's been in Austin for about 100 years, and the volume of people moving here, especially during South by, I mean, it's off the charts right now. So I think a lot of your colleagues in San Francisco and California are finding their way over here to Texas and pretty happy about it. And so we welcome them. And I mean, it's pretty obvious how much it's growing here. So, yeah.
Let me ask you a question. What are you seeing, because I have clients that are doing this, what are you seeing in terms of workforce housing, whether it's Austin or Dallas area?
Yeah, I mean, it's absolutely needed. They're, getting pushed out further and further from the city, which doesn't help our traffic situation, obviously. But there's some really nice incentives for the workforce housing. And so we're seeing it pop up constantly. I hear about deals all the time. I'm not really personally into the multifamily space, but I have friends who are, and the tax incentives here are very, very attractive for that. And a lot of family offices are backing these types of deals.
What about Section 8? What's going on in your area in terms of Section 8 here in LA? The worst buildings are turning into Section 8 or VA housing, Veterans Administration housing. Are you seeing that in your area?
Not as much here. Not as much here, frankly. Fair question.
I think that's great. I have a couple of comments to make, but probably at the end of this. So I think with regards to workforce housing, most of the guys who have done the great development of workforce housing, like there's like a guy, Rich Richmond, who has like about 150,000 units in the United States. They have either aged out or now they're doing higher end developments. And it seems like there's a big hole in the people who do workforce housing.
Yeah, it's a trade-off. I mean, with us, we're in the Fort Worth area. We have a property. I think it's for the city to think, or frankly, somebody that, you may own a bunch of restaurants and he really likes his staff with great loyalty, something where turnover might be less than 10% versus 50%, every few months or so. They said, hey, can I get a fair piece of land in a city, maybe not in city proper, but one of the adjacent cities here. So my team can be here so we can offer 3 or 4 restaurants to the community. And cities just have to make that judgment call here. So it's going to vary. I know historically, Austin here at Mueller, it's not Section 8 or workforce housing, but they ensure the development, at least a quarter went to teachers, musicians, folks that were at, probably 80% of, median income, which made it a real vibrant community, still close to downtown. So, a little less weird, a little less artistic, but at least, there's still some teachers, which I know can't be said in all big cities.
In my only other comments, I kind of have a post-apocalyptic view of cities. I don't know if any of you here has been to Atlanta, but Atlanta has, in the Midtown Atlanta, there's a lot of these, connectors between, like sky bridges between buildings, right? And people never go to the ground. They just go right into their building park, and then they've got malls in the upstairs of their office buildings, et cetera. They never have to talk to people. I mean, the streets themselves are kind of, odd with homeless people, et cetera. So I think that's where most cities are going. I think New York's fighting that, but I think it isn't, it could be inevitable in places like, I don't know, LA or San Francisco, where security matters the most from being in a city. So I'm like, buy secure buildings. Like security to me is everything, right? Because if you run a business out of New York and somebody gets assaulted, you want to make sure they're safe, right? Or what are your thoughts on that, Jeff?
Jeff, go right ahead.
Well, I was going to say, it's not so much, in San Francisco, it's not so much the building per se. It's actually getting from your car, getting from the bus, getting from BART to your building. And and we're seeing, at least in downtown San Francisco, a much larger police presence on the street. And I know it may not sound comforting, but that's distracting a lot of people from breaking in Union Square and from committing crimes in the the central business district. So I don't know that San Francisco's set up with skyways. I mean, Embarcadero Center kind of has it, but really the retail's on the ground floor. And I would say that unfortunately that's not doing very well right now just because of foot traffic. But anyway, I'm not sure that answered your question, but
It's a statement more than a question. I just think that security matters the most. Everybody's afraid of going into cities, in certain cities, right? So I think it's kept people back, although it seems that people have come back in New York, but New York is not as secure as it was 10 or 15 years ago. So anyway,
Marty.
great job, guys. Thanks.